Hi, this is Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. Welcome to the weekly Top 3, the top 3 things on our mind here at Alaskans for Sustainable Budgets for the week of October 13th, 2025. The weekly Top 3 is a regular segment on The Michael Duke Show. The show broadcasts on both Facebook Live and YouTube Live, as well as via streaming audio from the show's website, weekdays from 6 to 8 a.m. I join Michael weekly in the first hour of Tuesday's show from 6:10 to 7 a.m. for a discussion between the two of us about our 3 issues. We post the podcast of our discussion following the show on the Alaskans for Sustainable Budgets Facebook, YouTube, SoundCloud, Spotify, and Substack pages, also on the Alaskans for Sustainable Budgets website, as well as the project's page on national blog site, medium.com. You can find past episodes of the weekly Top 3 also at the same locations. Keep in mind that in addition to these podcasts, during the week, you can also follow and participate in the discussion with us of these and other issues affecting Alaska's fiscal and economic condition by following us on the Alaskans for Sustainable Budgets Facebook page and through our posts on Twitter. This week, our top 3 issues are these. First, we discuss EIA's most recent oil price forecast, why the oil futures market is starting to trend the same way, and what that means for Alaska's fiscal situation. Second, we explain how all the enthusiasm over the Ambler Road and other new projects may result in even deeper PFD cuts in the future. And third, we explain how John Faulkner's permanent fund inflation proofing argument in Must Read Alaska undermines both the current 2-account system and the PFD. And now, let's join Michael.
The weekly top 3, and it all starts off with where is oil going? And what I mean by that is the price of oil, because, of course, our whole economy is built on this madness. And here we are, this command economy, and we're kind of at the mercy of it. So tell us what's happening in the oil situation. Where do we go? Where do we go from here, my friend? Where do we get started?
A couple of months ago, we talked about on the show the latest Energy Information Administration for price forecast for the following. I think they do it for 18 months, year and a half forward. And the August forecast from EIA was significantly different from the forecasts that had been making up until that point. It reflected the impact of the OPEC production increases and showed a significant softening in the market as a result of oversupply, significant softening in the market, and a significant drop in price to absorb that additional oversupply. Futures prices were up in the high 60s, touching 70 at the time, and I know a lot of people discounted that projection. EIA came back and did it again in September and made the same projection about where price was going. And prices had softened a little bit in the futures market at that point. And now they've come back again in October and continued to make the same forecast. And what we're beginning to see is the futures market is beginning to trend down. Not as far as the projections yet, but the trend from where it was and where it is now gives you an indication that it may be going where EIA thinks it's going. EIA is what EIA is seeing, and what the IEA, another energy source, is doing, energy analysts are doing, is they're seeing this OPEC production really hitting the market hard, resulting in storage buildup because there's no place else for it to go. And when you're building storage, that really softens the price because people would prefer to sell the oil rather than put it into storage and incur the storage fees for an extended period of time. So it really impacts price. And what EIA continues to see is the OPEC production continuing to continuing to stay high and continuing to build storage and bring the price down. What happened the last couple of months is two things. One, you still had summer demand, summer refinery demand. Refineries, oil demand is strongest in the summer, in North American summer, because of gasoline. So you still had summer demand, and that was sort of masking what was going on. And then the Chinese have been building their own storage, have been buying oil on the market and putting it into storage. Some people describe that as the K oil industry, with real oil demand, consumption demand going down or softening, and the Chinese demand going up as a result of storage. But both EIA and IEA see that storage, see China sort of nearing the end of that storage, and as a result, they're continuing with the price projection. If you have the chart and can throw that up on the screen, that would be great. You were just waiting, weren't you? This is the. Sorry.
Go ahead. No, I was just waiting for it. Go ahead.
So this is the EIA forecast from October, from last week, and it shows prices continuing to soften. It's divided into calendar quarters. As we all know, the Alaska fiscal quarter runs from the middle of the year to the middle of the next year. So the beginning of 2025, really the line that they have in the middle is the beginning of the Alaska fiscal year. It's the middle of the calendar year, but the beginning of the Alaska fiscal year. And you can see over the course of the Alaska fiscal year, their projection coming down. The latest, the October projection has the average for the year, has it coming down to an average of $52 in the fourth quarter. And the average for the year in the EIA forecast is $59 a barrel, Brent. That's compared to the initial forecast, the initial spring revenue forecast of $68 or $68 that was forecast at the time that the spring revenue forecast came out, and on which our budget is based. And it also compares to the $64. If you'll recall, after the legislature passed the budget out, Department of Revenue came out with a different forecast than the spring revenue forecast, a revised forecast for FY26, took it down to $64, and the governor's vetoes were based on that $64, the revenues coming from the $64. So the legislature, you can see it in the Ledge Finance publications, the legislature still thinks that we're at $68. The governor's budget, which the legislature partially rejected, was at $64. And now EIA is telling us that we're headed toward $59. The current futures market is at $64 average for the year. So it's down certainly from where the legislature thinks the market is. It's the same price that the governor's vetoes were based on, but EIA is telling us it's going even lower. The result of that is that if EIA plays out, and as I say, the futures market seems to be increasingly believing that's where the market is going. If that plays out, then we're talking about UGF revenues, unrestricted general fund revenues. The legislature thought that they were going to be at $2.33 billion. The governor's budget was based on $2.1 billion, down $230 million from that. But EIA's forecast is now sending us down to about $1.9 billion, a little bit over $1.9 billion. Long way of getting to this. People are still acting as if oil prices are going to be high for the year. Right. The legislature is still acting as if they're going to get $68. The administration said it was $64, and then you have the Department of Revenue, former Department of Revenue head Adam Crum, going off and investing $50 million out of the CBR because he said, "Oh, we're not going to need it." Well, we are going to need it. I mean, if these prices keep going down, we're going to have a very difficult FY25, and the EIA forecast for FY26 rather. And the EIA forecast for FY27, the current EIA forecast for FY27 is $53 a barrel, even lower. So those who are running around thinking, okay, we're going to be okay, and we're gonna get through this. Okay, prices aren't going to be great, but we're going to get through the very tight budget, as some said, that we passed this last year. If prices keep going in this direction, and EIA is telling us again and again and again that's where they're going. If prices keep going in this direction, we're going to have a very difficult spring next year as everybody sort of wakes up and says, where did all the revenue go? And we're going to have an even more difficult time heading into FY27 with prices projected at $53 a barrel. It's going to make for a very interesting election year.
Well, I mean, this is what we've been saying for the last 10 months on this program, that the next year is going to be, in some ways ultimately brutal, and we should be prepared for it. And yet they and it was mentioned during the last session. I mean, Bert Stedman was like, well, we know it's gonna, but we don't want to pay attention to that. Don't pay attention to that. We want to focus on this year. Again, the short-sightedness. It's mentioned in passing, and then it's a shock, I tell you, that we're out of money and we don't know what to do. That's kind of this is like a redo. Like I said, Groundhog Day.
Yeah, the supplemental. When Ledge Finance issued their last newsletter, they were talking about what was going to be needed for the supplemental, and they said, well, of course we have this reserve this surplus that was set aside in the spring budget based on $68. We have this reserve, but we're even going to outspend that. On the supplementals. The supplementals are going to be bigger than the reserve we set aside, so we may have to go into the CBR some. Well, that's based on that statement's based on $68. They continue to rely on the spring revenue forecast as opposed to the revised revenue forecast that Department of Revenue came out. That's not true at $64, and it's certainly not true at $59, which is where EIA tells us we're now going. So it's going to be a big wake-up call next spring. And legislators, I mean, this is really pitched to legislators and staff out there. You guys need to stop. You guys need to stop and sort of suck in some air and think about where this takes you. If this is where prices are going. Maybe not. Maybe they aren't. But I would stop with we got money to do this, we got money to do this, and we got money to do that, and we'll be okay. Don't worry about it. It's all based on $68. You need to back up and take a breath and really think about what you're saying.
As I look at this and I just keep seeing these numbers, and this is actually, it seems like this was just slightly better than what we had considered in our previous discussion of IEA, because they had talked about the oil being down maybe in the low 50s. So this seems like this is even a little bit brighter than what they were anticipating before.
Well, I sort of, by cutting it off, by giving you a fourth quarter average, I sort of made it a little better. The April, May, let's see, the March and April prices are $51. The May and June prices are $52. And if you go over to the WTI, those prices are lower, but we need to focus on Brent. So yeah, it's come up a little bit from where it was in August, but that little bit isn't worth a whole lot in terms of UGF.
Right. Well, and they've got to pay attention. They've got to wake up to where they're at, and where they're at is there's not going to be a whole lot of bailout coming from some kind of big oil prices. And you mentioned this, and I know you're going to get into it a little bit here in the next segment. You mentioned this this thing with Crum. This has kind of been a crazy thing. I mean, at one point, I agree with him. If they get down to the last $50 million in the account, then they've got bigger problems. But at the same time, what was going on here? What was with this $50 million? I mean, that nobody seemed to know about, or that everybody seemed to know about and nobody wanted to talk about.
I think it's Crum trying to be a big shot. I think it's Crum trying to say, hey, I'm the commissioner of revenue. I've got, all this money at my disposal. I can invest it how I want to. This is the type of investment, as we've drained down the CBR, really what we've said to ourselves is the CBR is going to be our cash investment. We're going to hold it in cash or near cash, liquid assets. And that's going to be our cash investment. And we're going to invest for the long term using the Permanent Fund Corporation. And I think this is Crum sort of saying, well, maybe I couldn't get this through the Permanent Fund Corporation, so I'll just do it myself through this investment. I don't know. Maybe we're going to see this get worse, and maybe we're going to see the people who Crum's invested with show up as big campaign donors, and then that'll set off all sorts of additional alarm bells. But even if we don't see that, what we're going to have seen is taking what we really have been preserving as our cash account for emergencies and for oil price drops and things like that. We're taking a portion of our cash account and we're setting it aside into a long-term investment. That's something that we've said we just weren't going to do,
right?
As we've taken the CBR down. So Crum for whatever reason, and I think it's just because he just wanted to be a big shot and say that he could do this. I'm the revenue commissioner. I can commit this money. But for whatever reason, it's a stupid move, especially in light of where oil prices are going.
All right, we're continuing right now with Brad Keithley, Alaskans for Sustainable Budgets, in the weekly top 3. Number 2 is on the agenda now. We just finished up with number 1, which was where was oil going? And now Brad says somebody needs to look at the financials of all these projects that we've got going on out there. And we were just talking about this the other day, right, Brad? I mean, the whole gas pipeline, and we still haven't seen the updated finance. But somebody needs to look at the financials of all these projects. What do you mean exactly?
Well, there's been a series of headlines that just sort of, every time I see one, I rush to the paragraph that talks about how we're going to pay for it. The most recent one was the Ambler Road. I mean, Trump made a big deal out of reversing Biden and reversing the protections that Biden had set on the road, and opening up the opportunity for the road. And people are now talking about it as if it's a done deal, but the feds aren't paying for it. I mean, they've opened up the permitting for essentially the state to pay for it. And the same problems that we had before, I wrote a column on this a couple of years ago when Ambler was hot and heavy at that time. The same financing problems that we had then are still around. The road is not going to be cheap. It's going to be at least $300 million. There's some estimates that say it's going to be 500. Some estimates that say 700. There's even one estimate out there that says $1 billion. And so you can discount the high end of those, but where's the 300, 500, 700 billion going to come from? AIDA has said that they're going to issue bonds for it, and the bonds will be financed on the back of toll road agreements that they're going to enter into with the mines. But the mines that are out there, the potential mines that are out there, are not yet permitted, and the 2 mines that people talk about most are really small deposit mines, short-term mines that would not be enough either in volume or in time to pay out $300 million in bonds. Also, where are you going to get the money? AIDA says it's going to borrow the $300 million by issuing these bonds. Bondholders are going to want to know that there's a pretty good certainty of payback. And so they're going to look at the mines themselves. They're going to look at the same thing that I just talked about. The mines themselves, where they are in the process, what the deposits are, the projected deposits are, how that's going to, how much of the toll road that's going to pay for, and the bond issuers are going to be skeptical about getting it paid back. So they're going to ask for additional assurances, additional guarantees, additional backups, and I think what we're seeing is sort of maybe unintentionally, but maybe intentionally. We're sort of seeing the same thing from all of these projects. They're building up public expectation. They're building up public, enthusiasm for them. They're building up public desire to see them go forward. They're going to say that, President Trump unleashed it and we're going to do these. And then all of a sudden we're going to look at where the hell's the money coming from to pay for these things. And we're going to see it start backing up on the legislature. And they're going to say, oh, we got to do Ambler. President Trump authorized it. We got to do Ambler. Bond market isn't there yet. The mines aren't there yet, but we got to do Ambler. So we're going to need some additional money out of the legislature and a guarantee out of the legislature to back up these bonds. I see the same thing from the LNG project. I see them going down the road, building up enthusiasm, holding community events, getting people excited about it. But there's things that the LNG project is going to want from the state, not the least of which is a change in the property tax assessment or tax rate on pipelines, which the Wood Mackenzie study that was done last year to support to support the numbers that said that it was sort of competitive coming into South Central. They already assumed that those projections assumed that the property tax rate would be lower for the gas pipeline than for the oil pipeline. So I think what we're seeing is the front ending of a lot of enthusiasm about these projects, and the expectation that once they get if they can get the enthusiasm whipped up enough to the point that people are going to be demanding them, then they'll just take it to the legislature and say, you got to follow through on this because we build up all this expectation. You've also got people like Shelley Hughes. There was an article in the Ketchikan paper where Shelley had been down campaigning in Ketchikan. She said, "Oh, we need to have a capital budget again. We've only had these skinny capital budgets. We need to be building things again." You've got, Port Mackenzie is building back up again. They're having public tours and trying to sell the project again, all of which is dependent on state financing. There's one other piece of this that when I start fitting the puzzle together, you start seeing these articles by Bruce Tancheman and by others about we can't afford the PFD anymore. The PFD needs to go.
Right, I saw that.
And we need all this money. There's a link between those two. There's a link between people, wanting to get on with these infrastructure projects or just projects in general, wanting to get on with these projects. Shelley wanting to do a capital budget, everybody wanting to get out there with these projects, building up the enthusiasm for it. And on the other hand, people starting to, try to say, well, we can't afford the PFD anymore. And the link is that's the funding source that people have in mind for how to support these projects when the enthusiasm builds to the point that they come to the legislature and say, oh, that project, that Ambler project that we want to go forward with, that President Trump approved, that everybody is expecting now to, turn dirt next year. What was it? The Secretary of Interior said it'd be built next year. These projects, well, we just don't have the money for it. Would you? And so you're going to have to come up with the money. And so they're going to link that together with the anti-PFD folks. And all of a sudden, whippo bambo, the PFD is going to be gone, and we're going to be spending it on all these projects that don't pencil out, that we need money for because nobody will lend us the money because the project isn't firm enough to be financeable yet. So I can just see this building, and I can see these two things moving in parallel, and it bothers me. I mean, because we don't have a financial plan for Ambler. We don't have a financial plan for the LNG line when
Right.
the LNG folks come to the state and say, you need to give us this, that, and the other thing to make this line.
When they come to the state. I mean, we still haven't seen the updated, right? I mean, we still haven't seen the updated metrics on that. What is it actually going to cost? We have no idea because nobody's actually even brought it forward. But don't worry, it'll be spectacular. It'll be spectacular. We're guaranteed that.
Yeah, and so I saw one post that said, "Oh, we need the Matsu port. We need the Port Mackenzie desperately." Okay, who pays? Who's going to pay for it? Well, we need to cut out the university. We need to cut the university back. That's not going to happen. I mean, people who are advocating these things and their explanation of how they're going to pay for it is we're going to cut something else. They're just living in dreamland. They're really those people who are out there building these expectations without financial underpinning for it, other than we're just going to cut somebody else. Those people who are building that out are really building up the steam that's going to result in the elimination of the PFD. It's going to result in the switch over to the second parallel stream of people talking about eliminating the PFD. And you can if you piece these things together, you can see it coming. So if somebody believes in the PFD, as I do, and believes in the importance of the PFD and the importance of the role the PFD plays in the Alaska economy and to Alaska families, then we need to be skeptical. I am skeptical about these projects going forward without a strong financing plan, without their own strong financing plan, without ADA being able to issue the bonds without recourse and that sort of stuff.
I mean, if you were the Mad Emperor for a day, would you mandate that any one of these projects have to have some kind of fiscal note or plan attached to it that said, and here's how we, I mean, wouldn't that be part of the whole pitch to it? I mean, if you're doing a pitch deck, I mean, what, you know, because I've built a few pitch decks over the years. If you're pitching something, you know, in some kind of sales thing or whatever, you've always got a page that talks about the breakdown of the costs and how it's going to get paid for and what the ROI is going to be. You always put that in there somewhere. It's, I mean, you know, it's usually near the end because that's when you're asking for the money. But, you know, there's always something built in. I mean, shouldn't this all be part of it instead of this pie in the sky? We're going to build skyscrapers to the moon, and then we never talk about how it's going to get paid for.
Yeah, Ada in particular should be doing that. I mean, so and about Ambler in particular, what Ada says when they're asking about the financing with Ambler is, oh, we're going to issue bonds, and we're going to toll road. The road's going to be a toll road, and we're going to pay for the bonds with the tolls. Yeah, but you need to have mines. I mean, anybody who's going to buy these bonds is going to say, yeah, but you need to have mines at least permitted on these roads, and they need to be of sufficient volume and sufficient size that they're going to pay it out. I'm not going to lend you $300 million or $500 million or $700 million based upon, you know, just a statement that says, oh, it's going to be a toll road, don't worry about it. I want to know who's going to be paying these tolls, and I want to know that there's going to be money behind those people, revenue behind those people, in order to pay the tolls before I issue the bonds. And I'm going to say, as a bond buyer, I'm going to say, look, if you can't show me the money in terms of mines permitted and in terms of volume of production that's going to pay out these tolls, then I tell you what, give me a guarantee, give me a state guarantee, and I'll buy your bonds. But what we've done then is just really commit the states, you know, commit future revenue sources to underlie these bonds. People say, oh, well, we did it over at Tech Cominco. We did it over at the Red Dog mine. Well, the Red Dog mine, before we issued those bonds, the Red Dog mine was almost completely permitted. It was scoped in a way that they knew the volume of production that was going to come out of there, and they knew that volume of production was enough to pay the bonds off. So yes, we got bonds for that toll road, but it was in a much different place than Ambler is right now, and Ambler and in a much different place than Ambler is likely to be in the next 4 or 5 years. So if Burgum's out there saying we're gonna you know, build this road next year, I don't know where the money's going to come from.
Is the federal government going to? I mean, if you know he's saying that, but is the government going to pony up with the money, or is it just, you know, this is all aspirational at this point?
Oh no, when they were asked, they said, "Oh, it's going to be a toll road." They did the Ada defense and said, "Oh, it's going to be a toll road. Don't worry about it." Yeah, well, you got to have volume on the road to pay the tolls to support the bonds, and we don't have that.
Right.
And so as I say, I'm concerned we're going to get all this build up and all this expectation, and then Ada's going to say, well, we can't sell the bonds because we don't, and then everybody's going to say, well, legislature, you need to come back this up. You need to make it happen because we have all this expectation on all these people out there who want jobs and they're ready to go.
Well, and I can see another problem with this, with the legislature and everything else. Frank brings it up in the chat room. He said the issue with the Ambler Road is who gets to use it. If the state and the federal government build the road, it would have to be open to all the public. If it's built by private sources and it's a toll, they can control who uses it. And that's part of the problem as well. And I could see that being a sticking point with somebody in the legislature. Oh, we've got to have public access to it. And I mean, you know, it just, again, this is not all built into it. They should have all this laid out before they come out with these big, huge aspirational plans. You got to have a way to make it all work.
Yep. And we're certainly building up the aspirations. We're certainly building up the expectations. And we just don't have the money to back it up. And the projects aren't at a point where they can back it up themselves, at least in the case of Ambler. And certainly in the case of AKLNG also, they're not at the point where they can back up their projects. But we're going to build up these expectations. We're going to start all these trade schools and education courses to get everybody ready to go. We're going to, you know, everybody's going to be sitting there at the starting line ready to go. And then Ada's going to say, oh, but we don't have the money. So legislature, bail us out. And then the people who say kill the PFD are going to kick in and say, we got the money. Let's go.
David says it seems that the railroad line would be more cost effective and would ensure that the public would not be able to use it. But again, who's going to build it? And railroad, I think, historically is much more expensive than an actual road system. Or I mean, it's significantly more to build a railroad. David, that's part of the problem.
Well, and where's the financing for the railroad?
Yeah, exactly. I mean, how do you build it? That comes back to the big issue. Who pays? Where does it come from?
Yeah, it's
Brian says, how about we start with any plan? Oh, wait, cue the Alaska study industry, right? Because we're going to study the study that we studied before to study the previous study that we studied once before. I mean, that's exactly where we're at. There's a whole industry but baked up around that. Maybe the $50 million Crum just threw down the crapper would be a down payment on the roads, that's it. But I will say this, Brad, one of the interesting things that came out of this discussion about Crum and this $50 million was we got a little bit of a peek at the very end of this article in the Alaska Beacon, where they were talking about this specifically, was that Andy Josephson was talking about it, and he said he didn't think that the legislature will need all of the CBR. But he says he thinks there's a great concern about the fact that we need readily available cash, and that's what the CBR was designed to provide. And he goes on to talk about, Crum and the governor's veto and everything else. And he goes, it's just that we're suspicious. We don't know when we can have our $50 million back. This is the attitude. This is all our money. We want our $50 million back. We didn't want somebody else spend. It's okay if we spend it, but we didn't want somebody else to have when are we going to get our $50 million back? I mean, was it me, or did the hairs in the back of your neck just go like that when he said something like that? Because that's the attitude, right?
Yeah, exactly right. And in terms of, the statement, we won't need it this year. Well, look, the EIA forecast for next year, or for oil next year, is what, $53 through FY27. So we may not need it all this year. God hopes we don't need it all this year, because we're going to need some of it next year. The spending is projected to go up. We have supplementals that are projected to hit in the spring, and we're going to be facing $53 or $55, or just pick a number in the 50s, any number in the 50s, even the high 50s, and we're in deep crap. So, yeah, the $50 million. I mean, Crum's defense of, it's just $50 million. That's not much of a defense, because after the end of this year, depending upon what they do with the FY27 PFD, after the end of this year, we may have less than $100 left in the $100 million left, less than $1 billion left in the CBR.
Right.
And so where do you go from there if you're facing another year of $50 oil?
Yeah. No, and the irony here is that, well, it was only 50 million, and I was trying to get us to cut above inflation and blah blah. And I'm like, with just 50 million out of a multi-billion-dollar fund, you were trying to, we're not even keeping up with inflation kind of thing. This was just some kind of test bed that you approve 3 days before you leave off. I mean, it just is so weird. The whole thing is just so weird. Maybe it was him just trying to put on his big boy pants. I don't know. I'm confused by it.
It's weird, especially, I mean, he's on the Permanent Fund Corporation board, right? And he understands the role of the Permanent Fund Corporation is to make these long-term investments, to make these plays in combination with other plays, risk weight the whole thing. They don't do a good job at it, as we've talked on other shows, but nevertheless, risk weight the whole thing, and always make sure you have, some hedge against a high risk bet like that. And he knows that, and yet he decided, out of the CBR, which generally was considered to be the cash account that we kept for emergencies, out of the CBR, he's going to make this $50 million bet instead of the Permanent Fund Corporation. If he thought it was a good bet to make, then he would have made it. He should have made it through they should have made it through the Permanent Fund Corporation. But for whatever reason, and it'll either be sinister if you see that there's been donations made by the people to whom he to whom he committed the money, or not sinister if there aren't, but still sort of odd.
Well, that's the thing. It's weird. It's not, like I said, if there's no connectivity through campaign finance or something like that, but just why? And maybe you hit on it. Maybe he just wanted to put on the big boy play. I can play with the big boys. I'm the, I just don't know. I'm trying to wrap my brain around it. And
that's sort of been Crumb's MO. I mean, we've gone through how many tax directors, we've gone through how many deputy directors of revenue. I'm the one. I make the call.
We're continuing now. Brad Keithley, Alaskans for Sustainable Budgets, the weekly top 3, the great debate. That's what Must Read's John Faulkner is calling it. It's a new series of articles that he's writing. He said this is the first in the series that frames Alaska's great debate regarding the permanent fund. The series will invite debate but promote a protective view of both the management of the corpus and the original dividend plan. We start this series with inflation proofing, a topic which has broad consensus and clear legal direction. But Brad, you have questions.
Well, so inflation proofing has been used by the Permanent Fund Corporation as a justification for moving to a one account fund. And the way they've used it is they've said, look, the way historically we've done inflation proofing is we've taken cash out of the earnings reserve and we've transferred it over to the corpus in order to inflation proof the corpus. And so the problem, says the Permanent Fund Corporation, is that's taking too much cash out of that plus the PFD demand on the earnings reserve is taking too much cash out of the earnings reserve to move over to the corpus. We can solve that by just consolidating the two funds together, and we won't run out of money in the earnings reserve. It's also been the need for cash for inflation proofing has also been a justification. The need to take cash out of the earnings reserve and move it over to the corpus for inflation proofing has also been a rationale that some have used, many have used, to cut the PFD, because you have the earnings reserve. You only have so much cash in the earnings reserve, and if you're trying to fund the PFD and you're trying to fund inflation proofing, the argument is you'll run out of cash. So you, particularly when they're not earning, when the permanent fund's not earning enough, permanent fund corporation's not earning enough to refill the earnings reserve at the rates they're taking it out for those two things. So what we need to do, says those, we need to cut the PFD in order to leave enough cash in the earnings reserve to move it over to the permanent fund corpus. We don't need to do that. We have inflation proofing is a non-cash item. It can be satisfied either through cash or through appreciated assets. And we have a lot of appreciated assets on the books. And as long as your appreciated assets are earning enough, there's enough appreciation in your assets, unrealized gains, there's enough appreciation in your assets, then you're inflation proofing the corpus through the appreciated assets. And I wrote a long column, or a couple of columns, a while back that analyzed the amount of unrealized gains or appreciated assets that we had in the Permanent Fund Corporation, and reached the conclusion that there's nearly enough of that generated every year, appreciated assets or unrealized gains, nearly enough of that to cover inflation proofing. The cash need, the supplemental cash need to cover the remainder of inflation proofing is relatively small. And if you do it that way, if you use the unappreciated assets to cover inflation proofing, the non-cash item of inflation proofing, and preserve your cash, not only do you not run out of it in the earnings reserve, you start building the earnings reserve back up, and there's enough cash to cover the PFD. You don't get people saying, "Oh, we need to cut the PFD in order to create cash to move over to the permanent fund corpus." So in the article, John's arguing that we've got to do cash inflation proofing, that we've got to have cash, that we've got to cover the inflation proofing requirement through cash, and that's just playing right into the hands of those who want to cut the PFD by arguing there's not enough cash in the earnings reserve to do both, and B,
playing right into the hands who want to consolidate the permanent fund into a single account by arguing that as you continue paying cash out of the earnings reserve, you're draining it down to the point that you don't have enough cash left in the earnings reserve to cover your requirements. I wouldn't think that John would be in favor of either of those. I mean, in the past, he said he supports the PFD.
Right.
And I wouldn't think he would be in favor of a single account, because the single account opens a back door into the permanent fund corpus. We've talked about that a number of times on the show. So I'm not quite sure what John's doing. I mean, from a general standpoint, cash is always better than appreciated assets, but appreciated assets are valuable. They've earned. I mean, the appreciation is the earning. You just haven't realized that earning by selling the asset yet, but those earnings are real. Those earnings are there. They're embedded in the asset. They're continuing to be invested by leaving your investment in that stock and watching it continue to rise, or that asset, and watching it continue to rise. So, I mean, from an accounting standpoint, unrealized gains, appreciated assets are as valuable as cash if you don't need them for something that you need to pay out. And we don't need to be paying out the inflation proofing.
Right. Well, and again, just to be clear, he doesn't advocate in this article per se for a single account, but as you say, he's kind of playing into that argument by, talking about inflation proofing. And the one thing he also doesn't talk about is the transfers. I mean, we transferred $8 billion out of the earnings reserve into the permanent fund corpus. And it was ostensibly, in fact, it wasn't just ostensibly, it was blatantly said that this was for future inflation proofing. And then they conveniently forgot about it a year later or 2 years later. They conveniently forgot about the billions of dollars that they transferred over and started talking about inflation proofing again, which again goes back into our theory that somebody wants the corpus to be combined. And this is a way to kind of create that crisis kind of thing. So, I mean, I don't understand it either. And it begs the question of, why are we so focused on that? Why would that be the starting point of a discussion on the permanent fund?
Well, maybe John thinks it's the non-controversial one. I mean, he does say we start this series with inflation proofing, a topic which has broad consensus and clear legal direction. Well, it doesn't have, I mean, to the extent anybody listens to me, it doesn't have consensus, because it's a bad thing to do, because it leads to PFD cuts, and it leads to the argument for the combining the two accounts into a single account. And clear legal direction, I don't know. Earnings, what the Constitution says is that the legislature shall deal with the earnings off of the corpus. Well, earnings come in two types. They come in cash. If you cash out an asset and realize the gain on it, they come in cash, or they come in unrealized gains, appreciated assets. And those are, from an accounting standpoint, those are the same thing. I mean, they are the equivalent. So in terms of clear legal direction, I don't know if there's clear legal direction. Certainly not from the Constitution. Well, there's not clear legal direction that you have to use cash.
And isn't there some conflicting, because I mean, I thought under SB 26, which was the POMV draw, there was a whole change to the inflation proofing component anyway, right? I mean, so now you've got kind of dueling statutes, and there's a different way to handle it. So is there clear legal direction? I guess depends on which statute you're paying attention to.
Yeah, I mean, everybody talks about these dueling statutes. They really aren't. They can be reconciled. But I don't. I mean, there's not clear legal direction from the Constitution, at least. There's not clear legal direction that you have to use cash to cover inflation proofing. In fact, the Constitution doesn't talk about inflation proofing at all. It just talks about maintaining the corpus, that you can't spend the corpus, and it talks about the earnings, and the legislature can do whatever it wants with the earnings. I agree that inflation proofing is useful. I agree that it's important. It just doesn't have to be done in cash. And there are significant downsides in terms of draining the earnings reserve, and in terms of putting the PFD at risk by requiring that you use cash for what essentially can be is a non-cash requirement on the other side.
We'll get 2 minutes here, Brad. What would you say to John Faulkner if you ran into him at the store and said, "Hey, I read your article and I don't understand," or what? Give me the 90-second version of what you would say here.
John, I don't understand why you're arguing what you're arguing, because A, it plays into people's hands on cutting the PFD, and B, it plays into people's hands on consolidating the two accounts and opening a backdoor into the corpus. I thought you were against at least one of those, if not both of those. So why are you supporting something that leads to both of those together? Doesn't need to be cash, John. It can be appreciated assets or accounting gains, and we can satisfy inflation proofing with it.
That was a weird entree into the whole debate about the PFD was the inflation proofing. That would have not been probably the point of entry that I would have taken, but to each his own. I think John and I are probably in alignment on most things regarding the PFD, but that is kind of a weird entree. But any final thoughts here for everything we've been discussing today?
I'm going back to the beginning, Michael. I'm going back to the first segment. I am concerned. I follow EIA and IEA and OPEC religiously. I follow what they say about the oil markets. I follow the oil markets. I do weekly charts that look at what the oil markets are doing. I spend a lot of time on it every day on where oil markets and the prices are going. And at first, when EIA came out with this and the futures markets were sort of someplace else, I thought, okay, occasionally the EIA goes off on a tangent, and maybe this is one of those tangents. But then they stuck to it the second month, and I thought, well, yeah, they're serious about this. And now they've stuck to it a third month, and you start seeing the futures market showing the same trend across the remainder of the Alaska fiscal year, and I'm concerned about it. I think this is realistic. And now that Trump solved the Middle East, you don't have that risk sitting in there that always sits underneath the oil markets, and of some sort of flare up in the Middle East that will bring prices back up. And China has built a whole lot of new storage, but they seem to be filling it up. And so you can't count on China continuing to support the market over the remainder of the year. I mean, EIA is saying you can't, and IEA is saying you can't. Count on China supporting the market over the remainder of the year. So I am concerned and increasingly believe the strength of what EIA is projecting on these prices and the impact of that on Alaska in terms of what we're going to face next spring from a budget standpoint, both the last part of the FY26 budget and making the FY27 budget. What we're going to face next year, if that's where these prices go, is just going to be huge.
Well, because like you were saying earlier, this discussion about the supplemental and, oh, don't worry, we've got this extra money and we've put it aside, and then it's all been sucked up by the fact that the oil prices have plummeted. What's the supplemental going to be? $250 million, next year, just for this current fiscal year, let alone what's coming in the next year. I mean, we've talked about that. This is a significant, challenging time. This is not a time that I would want to step up as governor, quite honestly, personally, but somebody's going to have to do it, and somebody's going to have to take the reins on this thing, and it's going to be a hot mess.
Yeah. The candidates who are talking now about full PFDs, I love the discussion of the full PFD. I think it's important. I think it's central to the Alaska economy. I think it's central to Alaska families, middle and lower income Alaska families. I strongly like candidates who talk about that, but they're going to have to be ready to talk about how the hell they're going to balance the budget otherwise. And the 2018 Dunleavy, we're going to cut our way to it, just ain't going to work this time, because we saw where that went. So those candidates are going to have to be ready. Even the candidates who say, the PFD is important, but maybe we need a more reasonable level. Even those candidates are going to have to be prepared to talk about revenues, because if these prices hit, and again, I have increasing belief that they're going to hit, if these prices hit, it's just going to be very difficult next year, both in balancing out the FY26 budget, but particularly if we're going to $53 in FY27, particularly in putting together the FY27 budget.
Well, I mean, look, a governor could be willing. And they could come in with a budget that hacks and slashes and cuts what we're looking for. But you've got to have a legislature that cooperates, and they're not going to do it. There's no political will. A governor can come in and be as strident and as strong and produce a balanced budget that pays a full PFD, shows it all, does what it is, cuts deep into government, but the legislature has got to sign off on it. And that's the problem. The stumbling block right now is the legislature.
Yeah. If I were Bernadette and Shower, I would be putting together a slate of candidates, legislative candidates that supported me. If I were serious about carrying through on what she says she wants to do, I would be putting together a slate of legislative candidates that's supportive on the issue, and I would be running with those, saying we can do it. Not I can do it as governor, because you can't, but we can do it. Vote for me and this slate of candidates, and we will do it. Now that would be realistic, but just running around as a single candidate for governor, saying I can do a full PFD and I'll do all these cuts, that's just not going to have credibility.
Yeah, well, I mean, it's aspirational. Again, I keep using that word today. It's my word of the day, apparently, but that's aspirational. You can aspire to do that, but what's the reality going to be? Again, we're reminded about what Dunleavy did. He came forward with that budget that Don Ardwin put together, and I mean, it was great until it wasn't great, until the legislature got a hold of it, and then it was tall man bad, and everybody lost their collective minds. But if we're faced with the reality of no money and that, I don't know. I mean, I just don't know, Brad.
Well, then we're going to have all the PFD eliminate the PFD people pipe up.
Yeah, you know what? Just go enjoy your music, Brad. That's what you need to do. Just go enjoy that music, my friend.
I intend to.
I hope you do. I hope you do. Appreciate it, my friend. Thanks for coming on board. We'll see you next week, okay?
Michael, as always, thanks for having me.
Well, that's a wrap for another week's edition of the Weekly Top 3 from Alaskans for Sustainable Budgets. Thank you again for joining us. Remember that you can find past episodes on our YouTube, SoundCloud, Spotify, and Substack pages, and keep track of us during the week on Facebook and Twitter. This has been Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. We look forward to you joining us again next week on the Weekly Top 3.